Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I got a special episode for you. I wanted to fit this one in right before we have a lot of action, potentially, with interest rates this month. So I brought my friend Dan Habib back from MBS Highway, and we're going to talk a little bit about what we're expecting from the jobs report this week. So this is going to air on Friday, the same day as the jobs report. So I kind of put Dan on the spot a little bit to be, see how his crystal ball is. His dad's won quite a few of the crystal ball awards, but this is Dan's chance to see how he predicts what might happen here with the jobs report. But also, we got a big Fed meeting coming up, and there's a lot of anticipation that there may be a Fed rate cut. Matter of fact, Dan will probably break it down for us, but there's a pretty high percentage of a Fed rate cut, but there are some things we got to get through before that meeting that could potentially change things. But one thing I also want Dan to talk about is the last couple times we've had some Fed rate cuts, we didn't see the big improvement in mortgage rates that we were expecting. So some people are even a little bit nervous on what happens if we get that Fed rate cut. What's it going to do to mortgage rates? So lots to unpack. This is kind of a preemptive conversation with Dan Habib. We're going to have him back after the Fed meeting. So Dan, thanks for taking the time. Let me put you in the hot seat as we kick off September with a much anticipated but very busy month for rates.
Well, thanks, Tony. And it could be a very good month for rates. We've seen rates trend a bit lower, and we all know that, boy, we'd love to see rates continue down and stay there for a prolonged period of time, because it's been a tough couple of years, but that would really do a lot for refinances and purchase activity. So right now, the market is focused on the September 17th Fed meeting. It's a two-day meeting, so the 16th and the 17th, but the 17th is when the Fed's going to deliver their announcement on if they're cutting rates or not, their statement. It's also going to have their SEP, or their summary of economic projections, where we'll get a new dots plot chart, which shows you where all the Fed members anonymously think the Fed funds rate is going to be this year and in the longer run, as well as where they think inflation, the unemployment rate, GDP, and other things are going to be. So the market right now is pricing in a 92% chance that the Fed's going to cut 25 basis points September 17th. So what changed, and what's causing the market to now think that the Fed's going to cut? Well, it was Jackson Hole, Wyoming, the symposium that they have there, where the Fed chair speaks every single year. And let me just make sure I'm sharing the right screen here with you. So I just want to go over with you some of his comments and show you why the market interpreted this as the Fed's going to cut. Because he didn't come right out and say it. You always have to look very closely at the verbiage that the Fed is using. So he finally pointed to the fact that the job growth slowdown has been much larger than they previously thought it was just a month ago. And now, obviously, as we'll get into, he's talking about the latest jobs report that we got for July, which showed some huge negative revisions, really making May and June much, much, much weaker. And he said the risks to the unemployment rate rising are really, the downside risks to the unemployment rate rising have really been more elevated. And if they materialize, that this can happen very quickly, you'll see more layoffs, you'll see rising unemployment. So he's finally addressing the side of their mandate, which is maximum employment, and they're putting a lot more emphasis towards it. Now, of course, they're worried about inflation going up, and they've been talking about how they're worried about inflation due to the tariff impacts. But now Powell saying his base case is that the effects of the tariffs will be relatively short-lived and a one-time shift in the price level. Now, that doesn't mean it's going to happen all at once, because we know there's still big trade deals that are out there with countries like China and India. But once everything is settled, it really is just a one-time price increase in his eyes, different than persistent inflation. So I was actually quite surprised and happy to see Powell finally acknowledging the slower labor market and being weaker than the BLS has been saying, only to revise the numbers lower, and to not be as worried about the short-run inflation we're going to get from tariffs, because he thinks they're going to be one-time price increases. And then, of course, he talked about how the economy was growing at a slower pace, 1.2%, if you average the first two quarters and annualize it. So here was his bottom line, where the market said, okay, the Fed's going to cut. He said, with policy in restrictive territory, which means the Fed has room to cut before getting to a neutral level and still be restrictive, and the baseline outlook, which means inflation being pretty close to their target when you remove the one-time tariff impacts, and the shifting balance of risks, which means now there's a greater risk to the unemployment rate going up, it may warrant adjusting our policy stance. So this is Fed code here for, hey, the Fed is probably going to cut rates September 17th. Now, of course, the Fed's looking at all the data coming out. Now, when this was said, it was August 22nd. So at that time, was there anything that could be released that could derail a Fed rate cut? Well, we got just at the time of recording, last Friday, the Fed's favorite measure of inflation, PCE, or core personal consumption expenditures, which is really the metric that they look at, that they want to see at 2% year over year as their target and their goal. And that came out a little bit hotter. On a year over year basis, it went from 2.8 to 2.9%, but it was exactly what the market was expecting. And it's what Powell even said in his speech that he was anticipating. So I don't think any of the inflation data that came out or that we're going to be getting, we'll get a CPI inflation report before the September 17th decision. I don't think that has any chance of really derailing things, because Powell has even said he's expecting inflation to rise in the short term here because of the tariffs, but that it will be relatively short-lived. Now, there is one thing coming out that I think has the potential to really bring into question the rate cut, but I don't think this is going to happen, but it's the jobs report. And as you mentioned, this Friday, when this video will be released, is when we'll be getting it. Well, let's first just take a quick peek at the previous jobs report, which really changed the Fed's tune and is the reason why they're planning on cutting rates on September 17th. So it was for the month of July. It showed 73,000 jobs were created. By no means is that a robust number. It was much less than estimates. But the real story here was the 258,000 in negative revisions to May and June. So initially, they thought May showed 144,000 jobs created, and June showed 147,000. After these revisions, May now is only showing 19,000, and June only 14,000. That is pretty flatline job growth. And in fact, the average negative revision this year is about 77,000 per month. Now, listen, June, when we get this August jobs report on Friday, when this will be released, that's going to get revised one more time. And in my opinion, I think we're going to see the June figure get revised from only 14,000 to a negative number. If that occurs, I think that'll get some attention, because it will be the first time in almost 5 years that the BLS reports a month with negative job growth. Now, the July figure at 73,000, that's going to get revised 2 times, once in this report and then in the September report again. I don't anticipate this number to stay here either. And we're going to go over in just a second here why we're seeing these bigger revisions, but the unemployment rate is going to be a big story as well. It went from 4.1% to 4.2% in the last report, but the real number was 4.248, which they always round this to the nearest tenth, but you could see it was a hair, 2/100ths or so away from being rounded up to 4.3%. And that would have been a bit of a different story, but this goes into my forecast for where the unemployment rate may go in the jobs report for August. And here's the other interesting thing. You hear about Fed members out there talking about how, well, the headline job creation figures are weaker, but there's less demand for labor, but there's also less supply because of what's happening with immigration. The thing is while the break-evens may have declined a bit, I've never heard anybody say that, well, that break-even is a negative number. And over in this, where the unemployment rate comes from, which is the household survey, we actually saw 260,000 job losses in the July report and 863,000 in the last 3 months combined. So I think we are seeing a turning point finally show up in these figures. So let's talk a little bit about what I think is going to happen this week with the jobs data, because this is going to be critical for the near-term direction of mortgage rates, but also will solidify if the Fed's going to cut September 17th, which I do believe that they will by 25 basis points. So you have the JOLTS report that's coming out. We've seen a clear trend of job openings declining. It's anticipated that they're going to continue to decline. I think we might even see a figure under 7.4 million. ADP, which is the precursor to the big BLS jobs report, it only measures private payrolls and those that have ADP as a payroll company, but it's actual data, which is good. but it's expecting 68,000 jobs were created in August. And, this is something that doesn't always sync up with the BLS. So over time, they track pretty closely, but it's not like you could look to the ADP report and get some really good clues because there's been plenty of examples of them being very, very distant from each other as far as the original release goes. But the big one is the BLS jobs report. So the market estimates is that there's going to be 75,000 jobs created, and the unemployment rate goes from 4.2 to 4.3%. Now, I think we're going to see a pretty weak headline figure, but as I'll explain to you, it'll probably end up much weaker because of the response rates. But initially, I wouldn't be surprised to see a number around the 75,000, but I do think ultimately it will be much lower. But 75,000, that's not knocking the cover off the ball. I mean, that's what the estimate is, that clearly the bar has been lowered. But I think the big story is going to be the revisions. You're going to get a revision for June, the final revision, and then for July. And I think June can be negative. And I wouldn't be surprised to see the unemployment rate go up from 4.2 to actually 4.4%. Because remember, we were a hair away from 4.3%. So it's not going to take that much more to see this thing go up to 4.4. That would be a big story and really probably spook risk on markets, but really help the bond market and mortgage rates. And here's something that Fed Governor Waller, who's one of the candidates for the next Fed chair, he spoke about just last week. And I thought it was fascinating because a lot of people are questioning the jobs data and the accuracy of it because of the revisions. And a lot of them point to the response rates. So that means how many people are responding to the BLS. So let me explain to you how it works. The BLS gives you 3 months to respond. And 10 years ago, the response rate was 95% over those 3 months. But 75% of companies responded in the first month, which means that over months 2 and 3, you got 20%. Well, today, you're still getting 95% response rate over the 3 months, but here's the big difference. Only 60% are responding in the first month and 35% over the next 2 months. What does that do? Well, you're getting much less data upfront in that first month, which is why over the subsequent 2 months, you're starting to see bigger and bigger and bigger revisions, which is why I think that when all the data comes in for June, you're going to see that turn negative. And clearly there's a trend once the data fully comes in of the numbers being weaker and weaker and weaker. Fed Governor Waller thinks that those bigger revisions show an inflection point in the labor market and that there's more weakness to come. I fully agree with that. But I think a lot of people out there think the jobs data is not as good. It's not that it's not as good, it's that it's coming in later, and that's why you're seeing the bigger revisions. And boy, it's going to be an important jobs report. I can tell you right now, if we see weakness, we see some revisions, we see that unemployment rate go up to 4.3, maybe 4.4, you're going to see a party in the bond market and you're going to see rates come down. And that is certainly going to solidify the Fed cutting. I already think that that's going to happen. But the one caveat is the BLS, not the most reliable. If for some reason you got some crazy blockbuster job creation number, and you saw the unemployment rate go the other way and actually move lower, that could bring into question if the Fed's going to cut, because after all, the Fed is changing their stance here and cutting September 17th because of the weakness in the labor market. Do I think that's going to happen? Absolutely not. I think we're seeing a deterioration in the labor market. And there's a couple of reasons for that. I mean, I see some slowing going on in general. There's a lot of uncertainty with the tariffs where you have companies pausing. AI is giving a lot of companies out there some reason to take pause and also hire less. So a lot going on. I think it's going to be a good week for the bond market after we get some of this jobs data. And then ahead of September 17th, we're also going to get the QCEW data, which this is the actual figures from the BLS. Every month, they give you their monthly job estimate, and then they revise it in the subsequent 2 months. You get your response rate there of 95% in total from companies, but they're still using sampling. Much later, you get the QCEW, Quarterly Census of Employment and Wages data, and that's the actual data. Well, on September 9th, we're going to be getting the final numbers there from the QCEW for Q4 of last year. That is expected to show around 60,000 per month in negative revisions to each month in the fourth quarter. So, boy, you continue to just see these jobs figures get revised lower and lower and lower when you have all of the actual numbers. I think we'll see the same thing when we get in February, the first look at the numbers that we're getting right now from the QCEW. So, Tony, what we just went over is this. I think we're going to see weak jobs data. The Fed's going to cut September 17th by 25 basis points. But everybody is saying, well, that might not be the holy grail that people in the mortgage and real estate industry are hoping for, because what happened last year? September 18th, the Fed cut 50 basis points. November 7th, 25. December 18th, 25, total of 1%. And what happened with mortgage rates? They moved higher. It's important to explain here that, listen, the Fed, they're not cutting mortgage rates. They're cutting something called the Fed funds rate, which is a short-term rate. It's an overnight rate that banks use to lend to one another. And it does have a direct impact on other short-term rates. I mean, listen, if the Fed cuts your money market accounts, they'll go down, your short-term treasuries, your credit card rates, your car loan rates. But it has more of an indirect impact on longer-term rates. But here's what most people forget is that if you look at last year, sure, rates went higher, but there's reasons for that. But over a long period of time, there's a very good correlation. And I also think that if you look to last year, most forget that in anticipation of the 50 basis point cut, which this is the blue line, the Fed funds rate, mortgage rates actually moved down by about 0.5%. And then they were stable for several weeks until October 4th. And that's when we got the blockbuster jobs number, which I'll go over with you. So rates came down in anticipation, were pretty stable. And then we got some crazy jobs report. They cut again 25 basis points. Rates came down a little bit, crazy jobs report. Cut 25 basis points, same thing, crazy jobs report. And you got some hot inflation readings. So let's just take a peek at what happened here. Well, September, they cut. And then on October 4th, you get the September data, 254,000 jobs created. That caused rates to move higher and mortgage-backed securities to move lower. November, 227,000. December, 256,000. These were all blockbuster numbers that really made people think the economy was much hotter, that inflation was going to be more of an issue, and this caused rates to move higher, not necessarily the Fed cutting rates. And already we're seeing in anticipation of the Fed cutting September 17th, rates have come down a bit. And here's the other thing. We got in January and February the hottest inflation readings over that 12-month period that I'm showing you here from the CPI inflation report, which didn't help things either. But here's what I want you to look at and remember. This is the green line, 30-year mortgage rates. The blue line is the Fed funds rate. You could see it's not lockstep, and there's no guarantees, but there is a pretty clear correlation with mortgage rates and the Fed funds rate following each other, especially over a longer period of time. Now, at the end of the chart, you could see where you have the divergence going on. But again, I think that was more because of some of the jobs data that we had gotten and also the inflation data. I think now we're finally starting to get more indicative figures of what's really happening in the labor market. So I think if the Fed cuts this time around, we're already seeing rates move down in anticipation, but I think it will be a good thing for mortgage rates. So if you want to see lower mortgage rates, I think you should be rooting for a Fed rate cut, not the opposite. And I don't think what happened last year will happen again. That's my opinion, Tony, obviously, but I think if we look at a long-term correlation, usually they do track each other pretty well.
So that was fantastic. And thanks for breaking that down, Dan. I got a couple follow-up questions for you. So last month when we had that revision to the jobs numbers that was so significant, the chairman, I think it was the chairman or what the leader, if you will, of the BLS was fired, right?
Yes.
And they, I don't know if they brought
in
new leaders.
Yeah.
Okay. So was fired. Do you expect that to play a role in this BLS jobs report? Like, I would assume that was done because the numbers were so inaccurate. But I mean, is that really going to change or have any impact on this next jobs report?
No. Well, so the person replacing Ms. McIntyre is E.J. Anthony. He has not been confirmed yet. So, I don't think that the head of the BLS that was fired, was actually in there tinkering with the numbers and was, playing a huge role. I mean, at the BLS, certainly leading it, but I don't think she was having a direct impact per se on the figures. They have a bunch of PhDs in economics that are putting this stuff together. I think, you know, I don't want to get political by any means here, right? But there's certainly, the way that the administration had handled the response to this was that, you know, President Trump thought they were politicizing the figures, right? I think that the numbers, just based on how inaccurate they've been and how big the revisions have been, there's potential reason for making a change there. I certainly, don't even want to think about any of the other stuff there. I don't think that the BLS is trying to do a bad job, but if you're inaccurate with figures, just like in any other job, I mean, if you're the manager of a sports team and you continue to underperform and you don't make any changes, well, you're probably going to be coming under fire a bit. Or if you're the
Right.
leader of a company and you continue to, underperform with your earnings and your company's performance, they might look to make a change at the top there. And I think based on that alone, there's reasons to question if she was the right person for the job, because this is several years now we're going on where the revisions have been getting worse. They're using more imputed data, and they're not doing anything to change it. And listen, this is like probably the most important economic report that we get. And it's so important to us because you have the markets that obviously react hugely, and that has a huge impact on all of us, but also interest rates. Also, the Fed is making their decisions based on this report, as well as the inflation data from the BLS as well, the CPI and PPI reports. So you want to make sure that you are getting as accurate of figures as you can and that your methodology is correct. I mean, heck,
Right.
for the jobs data, they're still using snail mail for a lot of stuff. I mean, if it were me, I would enforce where you have to respond and make it digitized and maybe put less weighting in some of the inflation reports on imputed data like owner's equivalent rent, where they're calling households that own a home, someone that owns a home, and says, hey, how much would you rent your home for unfurnished and without utilities? I don't think most consumers are equipped to answer that question intelligently. Not that it's their fault. I mean, it's not an easy question, but that's the biggest weighting within the inflation report. So, I think that it's warranted to take a look and say, hey, maybe somebody should be potentially, leading the BLS a bit differently. But I am fearful with just some of the commentary out there where, it's because of politicizing numbers and stuff, because, she was replaced with somebody that the administration appointed, but you don't want there to be a loss of credibility at the BLS either, right? Because
Right.
you want people to believe the numbers, obviously. God willing that kind of thing wouldn't happen, but I don't think that her removal is going to have any impact on the data, at least yet, because EJ Antony has not been confirmed yet by the Senate. And then even when he is in there, I mean, boy, worst thing in the world would be if all of a sudden you saw the numbers just skyrocket, right? But I don't anticipate that happening.
Well, it's interesting for the administration because they obviously want lower rates. They want them to lower rates. Obviously, though, any administration is going to want to see strong job growth as well. So, it is
It's kind of counterintuitive, though,
yeah,
right?
totally
Because
counterintuitive.
he wants
Yeah.
you to cut. If you want to cut rates, it gives you a worse argument if you're seeing crazy jobs numbers, right?
Right. Exactly. Well, the one thing I will say about the jobs data, though, is everyone reacts to the headline and no one seems to react to the revisions, even though the revision. I mean, this last one we did.
They did
see
this
some
one
reaction.
because
Yeah,
they
this
were
one,
so big.
But every time, Dan, we've seen this forever. It's like they
Because
react
it's
to
old
the
news,
headline.
Tony.
I know, but it's relevant news because the numbers were inaccurate. I just want to see accurate data in real time. Another quick point out: if I remember, when Jerome Powell, I think it was, gave his projections for the 2025 unemployment number. 4.4 was they revised from 4.2 to 4.4. So looks like you're estimating we could be dancing with that number as early as September already. And
Definitely a possibility.
yeah, I mean that was his number. I called out on a podcast months ago that if you see unemployment get 4.4, Fed's gonna have to take some action because that was their own number.
I actually think in their last SEP, if I recall correctly, I think they moved it up to 4.5.
Oh, they did.
But initially it was 4.4. But I wouldn't be surprised if on September 17th when they release their projections again. They do it every other meeting.
Oh, okay.
If that were to go up to 4.6,
They just keep raising the bar, right?
well, our projection since the beginning of the year has been 4.6 this year, but we'll see how that plays out. But yeah, I mean, it's most likely going to go to 4.3, but I think there's a chance of it going to 4.4 because of how close it was to 4.3.
So last question. I think you might have a few more slides, but so as a mortgage professional, right? We try to time the market as best as possible. Hopefully most people invest in their business by subscribing to MBS Highway. You get this kind of commentary every single day. You can watch the market. But speaking to loan officers here, if the jobs report is a miss, the market is probably going to rally on this Friday, the day that this is coming out. Do you think that would potentially be a better day to lock, or do you wait until the 17th when you get the Fed rate cut? And do you think it could just keep getting better after that, or do you think that the market is going to kind of bake in, like we talked about, the anticipation of the Fed rate cut, especially solidified by a weak jobs number, if that's ultimately what happened today? I don't know. Do you have any thoughts on that?
It's a really good question, and I don't think there's a one size fits all answer because it's going to depend on your client scenario, how much time that you have. Also, there's no guarantees here, right? I mean, you could have the Fed cut, but they could have a very hawkish statement and press conference where, you could actually see rates move a little bit higher, at least in the shorter term. So, my advice there would be to talk with the customer about it. And listen, if we get some weak jobs data, which I'm anticipating, and you see rates fall a bit where, it makes sense, I would probably capture that because, there's certainly a chance that things don't go our way. There's no 100% guarantee here. And while I do think the Fed's going to cut, while I do think that is going to help rates, you might not have the time there. So it depends. But, what's the old saying? I think pigs get fat, hogs get slaughtered, right? If you're seeing some more attractive rates and it makes sense for the customer, you need to balance the risks there, right? Because it's not going to go down in a straight line. Nothing does, right? But ultimately, I'll show you my forecast for rates, and it's hard to put a time frame on these things, but if we were to look over the next 12 months, I'll show you like what my low target is.
Let's wrap up with that, Dan. I think that's a good way to close out this conversation.
So I think we could see the 10-year get down, which, by the way, the 10-year right now is around 4.28, right? So actually very interesting is that yields moved up a little bit. They were down like around 4.22 or so. They moved up a bit today as we're recording this because the federal appeals court ruled against the administration's authority to impose tariffs. Now, this is most certainly going to get appealed in the Supreme Court. We'll see what happens there. But in like a doomsday scenario where it's upheld, which I don't personally anticipate that to happen, but if it was, we'd have to pay back all the tariff monies received, which would just add a boatload to our debt, which means we'd have to issue a bunch more treasuries. We'd have to then absorb that in the bond market. So based on just that fear, we've seen yields move up a little bit. But nonetheless, yields right now, 4.28 on the 10-year. I think over the next 12 months, certainly, I think we could see them come down to 3.90. Now, there's always a relationship, and I don't want to just give you a number. Like, here's where I think 30-year mortgage rates could go to. I really want to kind of walk you through this, right? So this is for several reasons, but a lot of them also dealing with looking at the charts and some technical levels that I think that they can get down to, especially if we have some momentum, Fed cutting, weaker jobs data, inflation after some tariff impact is remaining pretty stable. And there's always a relative relationship between the 10-year Treasury yield and 30-year mortgage rates. Now, normally, if you look through history, 30-year mortgage rates are about 1.6 to 2% above the 10-year. So what does that mean? Well, let's just use round numbers. If the 10-year is at 3, that means mortgage rates are usually 4.6 or 5%, somewhere in that range. But there's periods of time where this spread widens and narrows. Boy, after COVID and stuff, you had these things fluctuate. You had all the quantitative easing, the spread went down. You had the Fed hiking, the spread went up. Boy, at one point in October of 2023, you had the 10-year at 5 and mortgage rates at 8 and change. The spread was like 3.1%. So I say this because the spread has been narrowing. Boy, just at like the beginning of the year, it was like 270. Now it's pretty close to like 2.25, which actually, believe it or not, has been our target this year. So I hope we're wrong and the spread continues to narrow, because that's a good thing for mortgage rates. It means that they, on a relative basis, are outperforming the 10-year Treasury. So if my target is 390 on the 10-year and we continue to see the spread either stay at the same levels, or if it narrowed, the target will be even lower here. But let's just say it's right around 2.25. Where does that put 30-year mortgage rates? Right around 6 1/8. So that's our target here at Highway, is that we're going to see rates at a low hit around 6 1/8. Now, some people might have been hoping for lower than that, right? But I don't think the bull market in our industry is as far away as many people think. I don't think we have to see rates get as low as many people think to see our business completely change. So first off, rates have been elevated for the last several years. So you have more people buying at higher rates, but you know that in all of last year, 2024, there was 1.3 million refinances. According to ICE's data, which, they're a little bit more conservative, where you have to have, at least 80% equity in the home, save 0.75% in rate. If you get rates below 6.5% for, at least a little bit of a period of time, there's 4 million refis that are available. But not only that, there is so much pent up demand on the sidelines. And, even if somebody has a home currently with a low rate, maybe they have 3%, are they going to go to, 8% or 7%, 7.5%? Makes it tough. But I think if we see rates get down to around 6 1/8, that will be enough for them to move. And remember, people are still having life events. Maybe they had a kid, they want the extra bedroom. So I do think seeing rates come down at that level will really spark refis, but also will get some more activity in the purchase market.
Well, I mean, I would have liked that number with a 5 handle. I'll be honest with you. I appreciate the perspective, and I also, that historical spread between the Fed funds rate and mortgage rates. It'd be nice if that closed
it's
down
between the 10-year and mortgage rate,
or 10-year and mortgage rates. Yeah, if that spread closed down closer to 2, that could put us at the 5 7/8 range, right? With a little bit further. So I think you're right. There's lots of refinance opportunity. I mean, look, right now there's cash out, debt consolidation opportunity. I did an episode that interviewed and did a survey of newer home buyers, especially millennials, and a lot of them really bought into that idea of marry the house and date the rate. Those guys are counting on refinancing their mortgage here in the near future in order to really put their budget back in line with where they expected it to be. So,
by the way, over the last few years, that strategy's been amazing. Because you've seen, if you bought a home over the last couple of years, I mean, you have lower rates now and the ability to refi, and you saw some great appreciation numbers. So it's been a smart play, at least thus far.
Yeah, well, I mean, I think the right time to buy a house is as soon as you can afford it. And if people were able to afford it, look, but I think they did count on rates coming down, and I think we're going to have those opportunities. Well, Dan, I want to keep this concise. This was a really good breakdown. As you're watching this, you can go check out what the jobs number is, because they'll be out. This is going to air at 10 a.m. Here on September 5th. We're recording it on Tuesday, the day after Labor Day. So look, Dan showed up, revived after the holiday and ready to go, because you nailed it today, brother.
Well,
I appreciate it.
Tony, should we give a guess for the jobs numbers?
We probably should, right? So 75 is what's anticipated, right?
That's correct. So,
okay.
All right, I'll give a number. Okay, so as I said before, I think it's going to be weaker. I think we'll see, a jobs figure. If I had to guess, I'm gonna put it at 68,000, and the unemployment rate I think is definitely going to go from 4.2 to 4.3, but I think there's a chance it goes to 4.4.
I'm going to pick a number in the 50s. I think it's going to be in the high 50s, 58. I'm going to go with 58.
And I think there's going to be some sizable revisions, which just like, in the July report, that was the real story. So we'll see. But I'm also going to go out there and say I think the June figure, which was revised from 147,000 down to 14,000, I think it's going to be negative in this report. So we'll see how we do. I mean, it's going to be as soon as this thing's released, an instantaneous grade.
Yes, it will be. Well, and I got to thank you, Dan, for look. You know, you got to love that, a guy that's willing to come on, knowing that this is being recorded before that data comes out, and willing to put it out there. That's some moxie right there. Well, look, guys, the reality is I get all my information about what's going on in the market every single morning from MBS Highway. So this information, you know, we talked about what's the best strategy, lock, you know, at the jobs numbers if they're good, or wait till the Fed meeting. The best answer is listen every day to the commentary, and you'll be given very good direction and warnings on when to lock in your pipeline. So even if you've, you know, used MBS Highway in the past and maybe you're not a subscriber now and you're like, well, it's so much going on. Like, how do you not run a mortgage practice with access to this information on the daily? Dan, I appreciate your guys' commentary. You do a phenomenal job, and for you taking the time to come on to Market Shares and share this with our audience. And I look forward to having you back after this Fed meeting. We'll unpack everything that happened, see if that makes any impact to your projections on where rates might go in the future. I'm going to go read up on what you were talking about with this tariff stuff, because that sounds interesting. I was wondering why the bond market was off today. And for those of you watching or listening to this podcast, thank you for your time and attention. We launch a new episode every single Friday. We try to keep it relevant. We try to keep it current. And we try to find great people like Dan Habib to come on and share with you. So to all of you, thanks for listening. Dan, thanks for coming on. And we'll see you all next time. Take care.